Well, good evening, folks. Welcome back to the channel. So I just wanted to cover the obligatory news of the day, and I'm going to reference a Wall Street Journal article on the Credit Suisse situation. Before I do that, let me share my screen and pull up. Here we go. So before we get into the Credit Suisse situation, we'll analyze the stock. But overall, the market had a really good day today. I don't expect it to last. I think we probably have another month or so of drops, and then we'll see what happens after that. But Credit Suisse is a pretty cheap stock. It's been, it's been on the decline for the last several years. If you look year over year, $10 a share last year at this time. It's down to 401, but it had a 10% drop today before rallying. But what's happened has caused some parallels to be drawn between 2008 and now, and I'll explain all of that in just a second here. But you can see the performance of the stock since 2018, year to date, 6 months, 1 month, and you see drop here, 5 days, and here was actually today, this morning, and then it came back. And I'm going to reference a Wall Street Journal article, which, funny enough, is not publicly available, but I just so happen to have a Wall Street Journal membership, one of the many value adds of watching this channel. So I'm going to kind of summarize this here. Concerns about Credit Suisse mount after debt slide. Investors and analysts call on the Swiss bank to move faster with cost savings, fresh investor capital. And a buzzword that comes up a couple of times in this article is something called a credit default swaps, I believe, or something. Yeah, credit default swaps, which were very common, very tied to the financial crash in 2008. Because there were so many defaults, starting like with Lehman Brothers and other companies, and that's what kind of panicked the market, or caused the sell-off this morning, and also caused a lot of CNBC hosts to immediately say this is not 2008. But the last major bank to face a similar situation was Deutsche Bank in late 2016. At the time, its risky debt also sold off, and many questioned whether it could continue on its own. It raised $8.5 billion of capital in early 2017, underwent a series of painful restructurings before stabilizing. Citigroup analysts on Monday said falling prices on Credit Suisse's bonds indicate its funding costs, or what it needs to pay to borrow, could rise by $300 million a year. But they said a capital increase isn't a foregone conclusion in their view, and Credit Suisse could finance its restructuring by selling and exiting the business. So this is kind of boring, credit default swaps. Like half of you probably tune out when you hear a big phrase like that, but I'll kind of break it down here in a second. See here, this is not 2008, referring to tweets and other claims on social media that Credit Suisse's problems could signal a broader meltdown coming in financial markets. I mean, hopefully we don't see 2008 or worse all over again, but the percentage drop in the market is close to what we saw in 2008. I mean, I don't want to live through another 2008. I mean, that was pretty bad. And, my thought is that there are some safeguards in place to prevent that. But the way you have the Fed raising interest rates, who knows? But yeah, it was we had very high unemployment. We had a lot of, the economy was in rough shape for a couple of years after that. Equity capital ratio of 13.5% at the end of June. Let's see. So look here, price of Credit Suisse perpetual tier 1 bonds issued July 2018. And they've been dropping all year. So today at the open of trading, the stock tumbled as much as 11%, but rebounded late in the day to end down less than 1%. Still, the shares are down substantially for the year, and its market cap is around 10.6 billion, less than half of what it was in February. Wow. So they've been hammered hard. The value of one of its riskiest types of debt, which can be canceled or converted to equity if a bank gets into trouble, fell around 70 cents on the dollar from 86 cents on Friday. The cost to insure against the bank defaulting on its debt using 5-year, here we go, credit default swaps rose Monday to its highest level in years. It cost investors 335 euros per 10,000 euros of exposure, equivalent to around 9,800 from 250 Friday, according to S&P Global Market Intelligence. The cost for 1-year credit insurance rose to 483 euros, meaning investors were paying paying up for the likelihood a default could happen quickly. Credit Suisse has quite a liquid balance sheet and its capital position is strong. The only thing that has changed given the eventful weekend is the pressure to raise capital. And yeah, this is kind of a canned statement here. But now let me cover what a credit default swap is and how this led to the 2008 crash. So if you just Google credit default swaps in 2008, first thing you'll find, 2008 financial crisis, the value of credit default swaps stood at 45 trillion compared to 22 trillion invested in the stock market, 7.1 trillion in mortgages, and 4.4 trillion in treasuries. In mid 2010, the value of outstanding credit default swaps was 26.3 trillion. So that's almost a $20 trillion loss. So you wonder, like, wow, where did all that money go? Did it evaporate or what? And then you'll see here, what role did credit default swaps play in the 2008 crisis? In 2008, the market value of credit default swaps fell when measured using the total notional amount of the contracts, but it almost tripled when measured using the market value of the outstanding swaps. Such an evolution is not surprising because default risks increased for many companies in 2008. Well, substantially for a lot of companies. And then how did the CDS, credit default swaps, contribute to the financial crisis? And this has to do with like mortgages, subprime lending, all of that. Some of that's, or maybe a lot of that has been cleaned up since then with different standards and stuff like that for lending. But I mean, I'm not totally convinced because, not to go down that rabbit hole, but when you only need 3.5% for an FHA loan to buy a house, I'm not convinced that the lending situation is cleaned up, in all honesty. So when the subprime CDS market began to experience losses, observers were quick to blame the CDS contracts. It was not the CDS contracts themselves that caused the losses, however, but the increase in defaults on the underlying subprime mortgages and the disappearance of liquidity for these securitizations. So what happens, in my opinion, it's like a domino effect. When companies are massively over-leveraged, once the influx of capital, once lending and all of this, like if people start to lose jobs, like take a mortgage, for example. So if someone gets a 3.5% FHA loan, say they get $1 million house and they put 35,000 down, and they have, 965,000 that they owe on the loan when they first start, and then they lose their job, and well, they're probably going to default on that house very quickly. And then if you have that happen a lot, you have a lot of job loss. It's like a domino effect. And then when companies are using different derivative instruments to over leverage, the effects are, it's like in options trading, right? You can lose more than you actually put in. So like the losses are magnified. And that's what happened like with Lehman Brothers and other companies in 2008. I'm kind of oversimplifying that, but that's the gist of it. And like subprime lending is like when people have less than, like there's such a thing, the prime interest rate, which is like the base rate of the economy. So when loans go out to someone with maybe poor credit or less than good credit, that's like that's kind of what the idea of subprime lending is. Higher rates, less likelihood of payback. It's like, think of junk bonds, like higher rate, less likelihood of return on investment, so to speak. We'll cover some more credit default swaps. When did they start? In the 1990s. Credit default swaps were originally created in the mid 1990s as a means to transfer credit exposure from commercial loans and to free up regulatory capital in commercial banks. Now, I'm not going to go on a dissertation here about this, but what happened, you used to have, and I've actually never talked about this on this channel, but you used to have something called the Glass-Steagall Act, which separated commercial banking from investment banking. So they were two separate entities. Well, once that was repealed in the 90s, that allowed a lot of this stuff to happen, which led to, as a lot of experts believe, led to the last big financial crash. Because so commercial banking, when you think about it, that's your mortgage loans, your auto loans, consumer loans, things like that. Well, investment banking is, banking for a gain. So when you remove the wall between those two and you mix them together, what's going to happen? What did the CEOs see? And I'm not saying this to be controversial. I mean, this is what I believe happened. So they see, okay, you've got a whole pool of commercial loans that can be securitized. It can be packaged into, new instruments like these these things called CDOs and things like that, collateralized debt obligations, and then all that, which is supposed to be, was supposed to originally be separate, was conjoined and used in investment vehicles, and then that's kind of how the domino effect started. But I'm kind of going on a rant here, but that's kind of the gist of what spooked the market today with this, and I just kind of saw this trending, so I figured I would, it's like the obligatory news topic of the day. So I've never gotten a chance to kind of nerd out on all this stuff on here and talk about collateralized debt obligations and investment and commercial banking, stuff like that. So, that's my opinion on that. Um, Kind of boring, but useful, good to know. And if you like that, please remember to like, comment, and subscribe, and keep an eye out for the next videos. Thanks for watching. Take care. Oh, some comments here. All right, I'm gonna end it now.